looking at the markets near all-time highs, just off of all-time highs for all three of the major averages. What do you think? You're worried that the market's getting a little complacent here. Why is that?
Yeah, look, I think, first of all, thanks for having me, Becky. But certainly the last correction we really saw in this market was back in October. And since then, the S&P has been up nearly 20%. Some of the sectors have been up more than that in a straight line. So, what I would say is that perhaps we're due for a little bit of a pullback here. Keep in mind, any given year, 1 to 3 pullbacks is the norm, 5 to 10%. But what I would clarify is that we're probably not due for what I call a true bear market, so a 20% plus type pullback. And that's because we're really starting to see the momentum build in this economy. Of course, the vaccine rollout here in the U.S. has improved. COVID cases are rolling over. This administration seems intent on getting another set of large stimulus out. And then, of course, we have the Fed that has committed yet again to remaining on the sideline. So overall, it's a really great backdrop for risk assets heading into 2021. What would make it even better is if we had some tactical opportunities to get involved, to really position in that, I guess, value cyclical, or at least start to layer in more of that value cyclical sector positioning.
Within that, you mean financials, the industrials, the energy stocks?
Yeah, absolutely. If you think about it, since really almost 1 year ago today, February 19th was the pre-crisis high. When you look at certain sectors, areas like financials, like energy, like industrials are almost flat, in some cases slightly down to that last February high, whereas sectors like technology and discretionary are up nearly 30% already. So already pricing in some of this recovery, whereas the financials, energy, industrial sectors may just be getting started in terms of finally breaking out from last February. So it's interesting dichotomy to see these sector performances since the pre-crisis highs. And I think there is a compelling reason to start layering in more of those value sectors. For us, it's not only the value sector, so it is small cap. And notably, it's also non-US assets. We certainly think areas like EM, parts of Asia, China could continue to do well and certainly could be a complement to your current US positioning as well.
We don't talk a lot about commodities, but maybe we should, given the runs we're seeing in some of them right now. You think that all of this additional industrial pickup could also lead to higher copper prices too, right?
Yeah, absolutely. We always had talked about gold as this, hedge against inflation and perhaps against low central bank rates. What we're starting to really look at now is more industrial metals. A metal like copper, for example, not only a reopening play in some ways because it's an industrial metal, but also a play on the longer term EV story, electric vehicle story, clean energy story. We're certainly seeing that in areas like copper, like silver as another example. And I know that got some headlines in the last couple of weeks, but these are metals that have long-term secular themes behind them as well. And so we're certainly optimistic that these could be the beginning of stories around commodities as well.
You're a little concerned about some of the stocks that have done so well, those COVID plays like technology. You think things are priced to perfection here?
Yeah, generally it does feel like when we talk about frothiness or fear and greed indexes or complacency, some of it is coming from that tech sector. However, we're already starting to see a little bit of sideways movement coming out of some of these sectors. Longer term, of course, when you think about a 3, 5, even 10-year horizon, some of the secular growth themes are here to stay. AI, robotics, cybersecurity, mobile payments, for example. All of these are we think, part of your core portfolio going forward. It's just when we look at the next 6 to 12 months where the real momentum may be more biased towards, that value cyclical play we've been talking about. And so certainly a balanced portfolio always makes sense. But if you haven't yet done so and you get the tactical opportunity, start thinking about layering in some of that cyclical story because it's really starting to build over the next 6 to 12-month period. Certainly that true reopening of the economy, that unleashing of pent-up demand, second half of this year could come to fruition in a big way.
Shepard Smith here. Thanks for watching CNBC on YouTube.